Okay, so it seems like, at least for now, the coast of Monday, Tuesday is behind us. But let's start a little bit more about what the long term outlook for the market is. Rohit Singhania, co head of Equities, DSP Mutual Fund, joins in on the show right now. Rohit, hi, morning. Great to have you today on ET Now. Rohit, a decent recovery from the March lows and then the speed breaker because of the Prime Minister's austerity call. Uh, does it seem that the market is going to remain in a bit of a limbo? And, uh, you know, could some of the factors like rupee, crude elevated, still above $100 per barrel, could they weigh in on earnings going forward?
Hi, good morning. Thank you for having me here. I think, what we have seen in the last 1 month or so is the risks have gone up, right? Uh, Till 1 month back, 45 days back, the view was, it's the war is not going to last for long. But the fact is, it's still going on, right? So I would say the risk has gone up. And the pressure of commodity prices going up and the impact it may have on inflation, we have still not, felt the actual impact because if you see the transport fuel prices, other prices have still not gone up a lot. So I would say yes, risk still remain in terms of supply chain, disruptions. They continue. With eventually, if this continues for longer, we'll see, price hikes also happening. So what it does to demand. So I think it's a wait and watch period right now. I don't think everything is very clear. But the pressure on currency, forex reserves, and maybe corporate earnings, like it's expected as earlier, would continue for maybe 1 2 quarters more.
Okay. Rohit, what's the kind of downside risk we are seeing to earnings? We're roughly at 18 times 1 year forward, if I've got that number right. Uh, do you believe risk reward starting to turn favorable or not so much?
I would say not so much currently, right? Because if you go longer term averages, if you take, I think 16 and a half, 17 is a fair multiple if you look at 2 years forward. So I would say risk reward is still not favorable. But right now, with the data which we are seeing, it doesn't worry me a lot, right? The concerns on earnings. So we have already cut down our earnings estimates for our holdings and, in terms of what valuation should we give. But I would say it's not a time to be all in. We need to be aware about the potential risk, which we haven't seen in the last 1.5 months since the war started.
So, Rohit, what is the fair value, according to you, for the index, the bull and the bear case for this year?
Okay, so I was doing that yesterday, with the team. So if you look at it historically, the range for the markets is, on a steady state basis is 17x to 20x 2 year forward, right? So if we were just looking at yesterday's Nifty at around 23,500, it was giving me an upside of 7 8% and a downside of 7 8%, right? So we are somewhere in the middle right now. So if these things continue, there is no deterioration in earnings, and for whatever reasons market have to correct 4 5%, then it gives me a better upside capture ratio and downside. So I would say right now it's 50-50. So I would not be all in or all out, but yeah, another 5 7% correction if at all the market corrects. I think that's the time I would go aggressively and buy more in my portfolios.
Hmm. Uh, Rohit, talk to us. What's the tilt currently looking like? DSP is known for this. Shut down small and mid caps whenever they're looking overvalued. Talk to us about what the tilt looks like currently. Is it still large cap heavy?
Uh, yes, I think we are still slightly large cap heavy, right, as DSP. But if you look at myself, when I've been talking for last so many years, right, as a fund manager, you don't start by saying, I want to buy a large cap stock or a mid cap or small cap, right? The portfolio construct in the end is done on bottom up basis. Whether you like the business or what price are you paying for it, what risk are you seeing in the next 1 2 years, right? So the portfolio construction overall is more bottom up. So it may be a case today, if I may tell you today, right? Small caps on a relative basis seem to be more expensive than large cap. But if you come across a stock which has the business acumen, the valuations, and you feel the business for the next 2 3 years is going to do good, I will still go ahead and buy it. I will not shy away saying it's a small cap. My small cap weight will go up. Why should I buy the stock? So the whole argument about small cap, mid cap, large cap is based on valuations, relative how they trade. So on that basis, yes, large cap seems to be, better placed. And in this current environment of uncertainty, right, where there are a lot of unknowns versus knowns. Historically, it tells us large caps tend to do better in these periods. So I would say yes, large caps in this period of uncertainty. But if you're looking at longer horizons, I think then it's the asset allocation of individuals in terms of small, mid, large that plays more important role.
But Rohit, that's the thing with large caps as well, right? That it's been such a polarized market, not just the sector churn which has taken place, but within sectors as well. There's so much, opposite ends. Case in point being banks sometimes, or many other sectors for that matter. Within the large cap pool as well, where do you think the alpha generation can happen, if at all?
I think we are quite positive on the financial space, whether it is banks, insurance companies, a few capital market plays. We also like telecom and few healthcare names. So I think these are the three baskets where we see, where we have valuation comfort, some comfort on the business outlook. So I think these are the three spaces, there is opportunity for alpha over the next 12, 18 months.
What's the thesis there?
The thesis again in banking is, you have a great balance sheet.
Yeah.
So, I mean, let's go back 5, 7 years, right? If this was a situation of uncertainty in corporate earnings, a little bit uncertainty in macros, right? The fear was, hell is breaking loose because of balance sheets, whether it was on the banking side or on the corporate side. Today, that fear is not there. Today, even if a pure commodity company comes and tells us, for the next 2 quarters, my profits are not going to grow or maybe they can fall. We don't worry a lot, right? Because they have strong balance sheets, less pain of interest, which they have to pay, less pain of debt repayment, right? So when you look at this segment, the whole thesis is with stronger balance sheets and with on the corporate side and on the banking side both, they can withstand this, slowdown in the near term. And again, valuations. So that's the call, as far as banking is concerned. On telecom, it's a steady business, right? They are not really impacted by what's happening globally. Like I need to use my telecom every day. We all are using our phones. We use data, right? So that pricing continues, the growth continues. So then that's pretty steady business if you look at telecom on that basis. This is how you see the sectors, in terms of who are getting impacted, who are not, and to what extent. So these are the bases, we like these names right now.
Okay. And Rohit, okay, so give us a tilt with regard to healthcare. That's the other big pick, which you seem to be bullish on. But valuations have run up, right? So how should one contextualize that? You believe that just the multi-year tailwind will carry these valuations lower, and therefore the multiples will remain elevated, and therefore returns will come through?
Yeah, so I think there are two ways to look at it, right? When you like something or you don't like something, right? One is the confidence on the business growth, and two, what price are you paying for it? Today, there are some sectors, where the valuations, if you look at the last 5 year, 10 year averages, the valuations are trading at one standard, two standard deviation below. But you don't have confidence on the business growth. Whereas in some cases like healthcare, if you look at hospitals and diagnostic centers, right, these kind of sectors, right? Yes, valuations have not corrected as much, but at least you have some visibility on business growth. So healthcare is a call more on the visibility of business growth rather than on valuations. Whereas banking, I would say, is a call pure on valuations and business certainty. And telecom, again, business continuity. So that's how I would put it.
What's the take with regard to IT, Rohit?
So IT, again, it's a wait and watch for me, at least. It's my personal view. So have gone wrong in the last 6 months. If you just look at the stock price and way the business has degrown and impact on margins. Every day is a new day today. So again, we as DSP, we're trying to understand what can be the actual impact. Is it a 1, 2, 3 more quarter impact, or it can continue for next 1, 2 years? So that work is still in progress. But as I said, this is one of those spaces where when you just look at valuations on an independent basis, you feel everything is very cheap. But when you compare it with business outlook or business visibility, you feel, there's maybe still time to wait it out. So I would say IT, I would still wait and watch. Our funds are slightly underweight on IT. And right now, there's no fundamental reason, at least which I can see, which, would make us change our view on IT and go overweight.
Interesting. Okay, Rohit, great to have you today on the show and give us your insight on the market right now.
Thank you all. Thank you.
Okay, let's take a break on that note. We're doing well actually. So we're holding out. We're back above the 23,500 print for the index. In fact, the futures are currently at 23,600. And it's a good market breadth once again, much like yesterday. We'll continue tracking markets, but on the other side of this short break.